Have you ever taken 5 winning trades in a row and felt, for a moment, like you'd finally figured the market out? The setups were clean. The exits were on point. The numbers in your account looked the best they'd looked in months. And then, in the 6th trade, you sized up. Just a little. Just because you felt sure this time. And that trade is the one that gave back everything the first 5 made. Plus some. Welcome back. This is episode 6 of our trading psychology series. Today, we're going to talk about the emotional state that almost every winning trader walks into eventually. It doesn't feel like a problem. It feels like progress. It feels like the moment you finally understand. But it's actually one of the most dangerous phases in trading. We're talking about overconfidence after wins. Quick explanation. For anyone hearing this term for the first time, overconfidence in trading isn't arrogance. It's not bragging. It's a quiet shift in how you assess risk. When you're losing, your brain treats every setup with skepticism. You ask yourself, is this really a setup? Am I sure? When you're winning, your brain skips that step. The setup is good. You feel it. You don't need to verify. That feeling is overconfidence. It's not a flaw. It's a normal response to recent feedback. The problem is, markets don't reward feelings. They reward process. And overconfidence is the moment your feelings start replacing your process. Let's start with the chemistry, because there's a specific reason this happens. When you take a winning trade, dopamine releases. We covered that in episode 5. The dopamine peak happens early in the winning trade, but there's a second effect that compounds over multiple wins. Each subsequent win produces a smaller dopamine spike than the last one. This is called diminishing reward sensitivity. It means, by your 5th winning trade, you don't feel as excited as you did at the first. Your brain wants to feel the spike again, the way it did when you were new. The fastest way to get that spike back is to raise the stakes. Bigger position, tighter conviction, more leverage. Suddenly the trade that would have been a normal 1% risk is a 3% risk. You didn't make a conscious decision to be reckless. You just wanted to feel something. The neuroscience of streaks is the neuroscience of escalation. There's a second mechanism worth knowing: recency bias. We covered this in episode 1, but in the context of overconfidence, it shows up differently. Recency bias means your brain weighs recent events much more heavily than older ones. After 5 winning trades, your brain treats your win rate as 100%, even if your historical win rate is 55%, even if every single one of those 5 wins was within a single market regime that's about to change. The data of the last few days drowns out the data of the last few months. And the conclusions you draw from this skewed sample are wildly distorted. You start believing, my strategy is bulletproof. I've got the rhythm. This time is different. These thoughts are not analysis. They're recency bias dressed up as confidence. The trader who knows this still feels the same temptation. They just have one extra checkpoint between the feeling and the click. There's a specific identity shift that happens during a winning streak. You start to see yourself differently. Not, I'm a trader who's having a good week, but I'm a good trader. That linguistic shift seems small. It isn't. When the streak was just a streak, you were still humble, still on guard. When the streak becomes your identity, you stop being on guard. Because protecting against losses now feels like protecting against your own self-image. The market doesn't care about your self-image. It will hand you a loss the moment your edge slips, and it will do it without warning. And when that loss comes, it doesn't just cost you money. It cracks the identity you just built. That's why the worst trade in a streak almost always comes immediately after the trader silently crowns themselves. The trader who never reaches that internal moment, who keeps thinking of themselves as lucky right now, instead of good at this, survives the streak. The trader who lets the streak define them pays for it. Let me describe how the streak actually unfolds in real trading. There's usually a 3-phase pattern. Phase 1, the validation phase. The first 1 or 2 wins feel good, but cautious. You're still checking your stops. You're still respecting your rules. You're slightly surprised at how well things are working. That surprise is healthy. You're still humble. Phase 2, the flow phase. Wins 3 through 5 start to feel automatic. You're not surprised anymore. You expect to win. The setups are jumping out at you. You feel like you can read the market. This phase is dangerous because it feels like skill, but it's almost always partly luck. Being in the right market regime at the right time. You start to break your own rules a little. Maybe you take a setup that isn't perfect because you feel it. Maybe you size slightly bigger. Maybe you skip your usual review process. You're rewarded for these shortcuts in the moment. The wins keep coming, but you're slowly disconnecting from the process that made the wins possible in the first place. Phase 3, the blow-up trade. Somewhere around wins 6, 7, or 8, you take the trade. The position size is bigger than normal. The setup is shakier than normal. The risk-reward is worse than normal. You take it anyway because you feel certain. That trade goes against you. Not just a small loss, a big one. Sometimes it wipes out everything the streak earned. Sometimes more. This pattern is so common across thousands of traders that it's essentially the default career arc for retail traders entering their first profitable run. The streak gives, the blow-up takes. The trader is back to square one or worse. Let me walk through a specific scenario that plays out almost identically across thousands of traders. It starts on a Monday. You take a trade, 1% risk, your normal size. It wins. Plus 3R, account up 3%. Tuesday, another setup, same size. Wins again. Plus 2R, account up another 2. Wednesday. The market is moving. You take 2 setups today instead of your usual 1. Both win. Plus 4R total. By Wednesday night, you're up 9% on the week. The best week of your year. Thursday morning, you notice a setup that's not quite on your list. The structure is similar to your normal trades, but the entry is rougher. Normally you'd skip it. But today, you feel like you can see the move clearly, so you take it. Same size, actually slightly bigger. You're up so much this week, the math says you can afford to risk a little more. This trade actually wins too. Plus 1R. Smaller than the others, but a win. Friday. The market is choppy. You take 3 setups, looking for 1 more win to close the week strong. 2 of them fail. Small losses. The third one is where it happens. You see a setup. You like it. You size at twice your normal, because you've been right all week. This trade goes against you. Hard. 2R loss. But at double size, that's a 4% loss on the account. Suddenly a 9% week is a 5% week. Still positive, but you can feel the air go out of you. The week that started as your best of the year ended with a bigger loss than any single trade in months. And the only thing that changed was the sizing on a setup that wasn't quite on your list. This story is so common it's almost a script. The losses come from the trade you knew was different. There's a cultural amplifier here that's worth naming. The hot trader persona on social media. Once a trader starts winning, the natural urge is to share it. Twitter screenshots, Discord posts, live streams. Your win rate becomes a public number. And once your wins are public, your psychology shifts in ways you don't notice. You start trading to maintain the public win rate. You stop taking setups that look slightly uncertain, because you don't want to ruin the streak in front of an audience. You size up because the audience expects bigger wins. You hold trades past your target because closing at the original target feels small. These behaviors are pure ego protection. They have nothing to do with the actual setup quality. And they accelerate the blow-up trade. The professional move, once you notice you're winning, is to share less, not more. Because professional trading thrives on emotional anonymity. When no one is watching, you can take a small loss without flinching. When everyone is watching, every loss feels like a personal failure. There's an angle here that connects to leverage. Overconfidence plus leverage is one of the fastest ways to blow up an account in trading history. In spot trading, overconfidence costs you a chunk of capital, painful but survivable. In perps, overconfidence at a higher leverage tier doesn't take a chunk. It takes everything. Most accounts get liquidated during streaks, not during losing streaks, during winning streaks. The trader was at 1 or 2 times leverage during the build-up. Confident, careful. By the 7th winning trade, they're at 10 times, or 20. The position size that felt comfortable when the streak started is now 10 times bigger. The same 1% move that meant a 1% loss now means 10%. The math of compound winners assumes consistent sizing. But human psychology under a streak doesn't allow consistent sizing. Position size silently inflates with confidence. And that's the mechanism. The trader doesn't suddenly become reckless. The sizing creeps up trade by trade. By the time they notice, the next loss is a liquidation event. There's an after effect that traps a lot of people in a loop. The post-streak shame cycle. The blow-up trade hits. You lose more on one trade than you made in the previous 5 combined. Your account is back where it was. Or lower. Now you feel deflated, embarrassed, stupid. You go quiet on social media. You stop posting screenshots. In your head, you replay the trade over and over. Why did I size up? I knew better. I should have stuck to the plan. And here's the dangerous part. That shame cycles back into the next pattern. Because traders who feel ashamed of a blow-up often become overly cautious for the next few weeks. They take smaller sizes than their edge warrants. They exit good trades too early. They miss setups entirely. And eventually, after a few weeks of underperformance, they reset their psychology and the cycle starts over. Confidence a streak, koi blow up, B shame, over caution, key reset, confidence. This loop traps thousands of traders for years. The way out is not to avoid confidence. It's to recognize that confidence and discipline are not the same thing. You can feel confident and still size at 1%. And still respect your stop. And still skip the setup that looks slightly off. When you separate the feeling from the behavior, you've broken the loop. So how do you train yourself out of this? I'll give you 3 practical rules. 1. Fix your position size in advance in writing. Decide before the trading session that every position will be exactly X dollars or X% of account, not around X, exactly X. Then, no matter how confident you feel, the size doesn't change. This sounds restrictive. It's exactly the point. Conviction shouldn't change your size. Conviction should already be assumed in your strategy. If your size only fits low conviction trades, your strategy is wrong, not your size. 2. Take a forced break after streaks of 5 or more. After 5 wins in a row, step away for at least 24 hours. No trading. No chart watching. No, just one more setup. This is hard. The temptation during a streak is to ride it. But the data is clear. The blow-up trade almost always comes at the peak of the streak, not at the start. A forced break interrupts the dopamine escalation cycle before it produces a fatal trade. 3. Journal process, not outcome. After every trade, winning or losing, write down whether you followed your process. Was the setup on your list? Was the size predetermined? Was the stop honored? Process journaling rewards discipline over results. After 30 trades, your journal will show you something important. Your best results came from process trades. Your worst came from feeling trades. This is universal. But you can't see it until you've journaled enough trades to make the pattern visible. There's a flip side worth knowing. Professional traders during streaks behave almost the opposite of retail traders. A pro on a winning streak gets more cautious, not less. They reduce size after wins, not increase. They double, check setups they normally would take without thinking. They take more profits along the way, not fewer. Their assumption is, if I'm winning unusually well, the market conditions are about to change. Not because they're pessimistic, because they understand mean reversion. Edges work over thousands of trades. They don't work in straight lines. A streak is statistical noise on top of a real edge. It will revert. The trader who treats the streak as the new normal gets caught at reversion. The trader who treats the streak as a temporary gift keeps the gift. That mindset is the most underrated skill in professional trading. Stay humble during wins. Stay focused during losses. Same person, same process, regardless of recent results. So to summarize today's episode, overconfidence after wins is one of the most common reasons traders blow up after a profitable streak. It's driven by dopamine escalation, recency bias, and a quiet identity shift from I'm winning to I'm a winner. The pattern unfolds in 3 phases: validation, flow, blow-up. It's amplified by social media and personally narrated win streaks. It's catastrophic when combined with leverage. The post-streak shame cycle traps traders in confidence, blow-up shame, over-caution loops that can last years. The 3 practical rules: fix position size in advance, force breaks after streaks of 5, and journal process, not outcome. Underneath all of it is one mindset shift. Confidence and discipline are not the same thing. You can feel certain and still execute exactly the same as if you were uncertain. That's the discipline that survives streaks. In the next episode, we're going to talk about an emotion that's almost the opposite of this one. Analysis paralysis. The trader who sees the setup perfectly and can't pull the trigger. We'll break down why some traders freeze at the exact moment of opportunity. Why over-analyzing is a fear response, not a discipline. And what professionals do to short-circuit the hesitation loop. Appreciate you all for listening. If you enjoyed this episode, make sure to subscribe and share it with someone whose winning streak just turned into a blown account. And I'll see you guys in episode 7. Start trading now on Mosey Finance. Trade perps everywhere with one dashboard. Link in bio.